Our learning objective for this lesson is the same as the introduction video, to describe the roles of financial reporting and financial statement analysis. Financial statement analysis evaluates a firm's performance and financial position based on financial statements and supporting information to enable investors and creditors to make investing and lending decisions, respectively. Let us check the slide's learning points. The first pertains to the time period context of analysis of financial performance and financial position. This question tests your judgment and appraisal skill according to Bloom's Taxonomy of learning objectives, which is a higher level of learning because rather than telling you this beforehand, we'd let you derive it yourself. This is how we teach you at eCPD Academy because we leverage your intelligence and prior learning. Now, I'm sure you would pick all of the choices given: past, current, and potential. The choices are not arranged in the order I mentioned because they are randomly ordered by the e-learning system. Let us try the next learning point, which pertains to economic resources and claims against these economic resources. The question asks, what describes a firm's financial position? The choices are expressed in technical language of accounting standards, so take a moment to reflect what they mean in ordinary language. Economic resources are assets just like your house, car, and cash. Claims against resources reflect ownership. For example, your house down payment is your equity, while the mortgage is your debt. The assets or economic resources funded by owner's capital of loans are employed to grow the business. Periodically, both owners and lenders would like to know how the business is doing, so company performance is measured and reported. Firm performance can be measured in how well it generates profit or accumulates more cash. Ordinary people without technical training in accounting would know that their business is growing if they receive more cash from customers than they pay suppliers and employees. This is cash performance calculated under cash-based accounting, which measures performance by cash inflow minus cash outflow. However, accounting standards require or allow counting revenues also when earned even if these are collected later, and deducting expenses even if these are paid later too. This is profit performance calculated under accrual accounting, which recognizes sales when earned rather than received and charges expenses when incurred rather than paid. Let us illustrate it with a simple example. A company buying and selling goods sold all it purchased during its first year of business. The table shows $100 of sales, but only $45 were collected, with $55 still owed by customers. The table also shows $70 of purchases of goods were made during the year, but the company paid only $25 of it and still owes its suppliers $45. The challenge is to answer the questions about the company's performance. But before we do that, the first question requires us to understand the concept of inventories, which pertains to purchased goods that remain unsold at the end of the period. The question is an analyzed question under Bloom's Taxonomy of learning objectives, which requires a higher level of learning. The question asks the balance of inventories at the beginning and end of the year given the information. Take a moment to examine the choices. Now, let us find out the answer. The answer is both zero balance of inventories at start and end of the period, because it was the company's first year of business and the company sold everything it purchased during the year. Let us move on to the next learning point with 4 calculation questions. But before we view the questions, take a picture of the screen, perhaps using your phone, or use Ctrl plus print screen and save on either Paint, Program, or Word document, so you can refer to the table data. Ready? These questions will reveal the answer as soon as we select an answer choice. The first two questions will ask for cash performance and profit performance. The last two are not covered in the lesson, but meant to give you added challenge as a preview to one common task in financial statement analysis, which is working capital. So the first calculation question is asking for cash performance, which is $20. The next question is for profit performance, which is $30. The third question is calculating net trade financing, which pertains to the amount owed by the customers minus the amount owed to the suppliers, which is $10. The last question is calculating net working capital, which is the business capital tied up to cash, receivables, and inventories after deducting the amount still owed to suppliers. The net working capital is $30, consisting of net trade financing of $10 from the previous question and $20 of cash balance. A company's cash performance is its ability to generate cash to pay debts when due. A company is liquid if it has enough cash to pay short-term debts. It is solvent if it has enough cash and other assets to satisfy long-term debts. But what is short-term versus long-term? First, let us understand a firm's operating cycle. The question stem states that a firm's operating cycle is the time it takes to buy or make goods for sale, sell them, and receive cash from customers. Therefore, an operating cycle is which one of the choices? At eCPD Academy, we thought to exercise your higher learning skill, so take a few moments to evaluate the choices. The question stem describes a cash conversion process, so we select the first option. The last two choices are mutually exclusive. As always, description cannot allow a maybe, so only one of them should be correct. 1 year seems unnatural to cover all kinds of businesses, so we choose maybe longer than a year. Now, let us reveal the answer. So we are right, and an example of a business with operating cycle longer than 1 year is making movies. Now that we know what is an operating cycle, let us find out how short-term versus long-term is defined in accounting. The next learning point asks what is short-term. Take a moment to evaluate the choices. Well done if you thought 1 year operating cycle, whichever is longer. The answer also provides examples of short-term assets and short-term liabilities. Let us build on further what you just learned. The next learning point asks you to differentiate between liquidity and solvency. The given data on slide 3 provides $20 net cash outflow, $55 uncollected sales or accounts receivable, and $45 unpaid purchases or accounts payable. The question is a true or false question, whether this information provides information only as to liquidity but not to solvency. Take a moment to think of the answer. The examples from the previous learning point question must have aided you to answer this question, where cash, accounts receivable, and accounts payable are all short-term accounts, and therefore the answer is true. Our last lesson slide illustrates how profit performance is reported on the news. If you are taking this lesson in our e-learning platform ecpd-academy.com, you will be following the links and read the profit news to answer the next learning point exercise. This real-world application using authentic materials is our way of training you to immediately apply what you learned at eCPD Academy. Pause this video so you can read the exercise links. Once you have done so, we can now proceed to do the exercise pertaining to profit expectations and profit earnings ratio. The first question asks, whose expectations does the news article refer to? The answer is the stock analysts. The second question states that profit performance is used in price-earnings ratio, actually as the denominator, but the question is asking what is a price-earnings ratio based on the context of the reference links. The answer is stock valuation. That concludes our lesson for the scope of financial statement analysis.